Let's talk today about state of the markets, and in particular, let's talk about what happened over the last year, 2024, what drove the performance of the markets last year, what we're seeing right here, right now in this year, and then of course, my favorite part is taking out the crystal ball and telling you my forecasts. You know, people say that there's no such thing as a crystal ball, but I think my bald head is similar kind of in shape and style, so I like to think that I have a crystal ball. It's a little bit foggy, a little bit murky, but it still works. It gets you in the right place, general idea. So in 2024, we had a really nice year. It was up, market was up about 23 to 25%. And it was a nice smooth ride was really the great thing. It wasn't just a good market. So it was a nice smooth ride. In fact, I was looking today because I remember that it was smooth. There wasn't a lot of like big drops last year. And I remember it being kind of comfortable, but I wanted to make sure that I wasn't making that up in my head. When I looked at last year, there's a couple of periods where the market was down about 3 to 5%, which is really nice. Because normally in a year, even when the market is up 10, 20, 30%, there's usually a point where the market is down, almost always a point when the market is down 10% or more. So not only was it up steadily, and when I say 23 to 25%, by the way, that's with or without dividends. Without dividends, about 23, with about 25. A couple of really interesting tidbits about last year, though. You got 4 places that you could follow my slides, right? You got 2 screens here, you got 2 behind me. That's probably just a small group here will look at the TV screens. But going into the year, I always love looking at what the top economists in the world forecasted and what actually happened. So what you see on the screen here is Morgan Stanley, JP Morgan, RBC, Bank of New York isn't on there, the first stock. So these top economists in the world, besides, Cody introduced me that way, I appreciate it, said that the market would be up 1% last year. They thought the market was going to be flat. They weren't just wrong, they were way off, right? And we find that they tend to be off, and the running joke is that the best jobs are being an economist or a meteorologist, right? Because they get paid to be wrong. If you're right like 20% of the time, you did a great job. I want to talk about why it was such a smooth ride as well. Byron presented this last night in Florida, and what he talked about was the sweet spot. And last year really was the sweet spot. Several great components came together. We had modest inflation, we had modest interest rates, and we had good unemployment. That's going to be a trend throughout the presentation tonight. And all that, and we had good corporate earnings and growth that we're going to talk about. All of that comes together to this perfect sweet spot. If you're a tennis player or a golfer, whatever your sport is, whatever that sweet spot is, or when you're in the zone, last year was the zone. So we're going to look at that for last year. We're also going to look at how that correlates and relates to what we're expecting or seeing this year. So here we go. GDP growth was 2 to 3%, which is the perfect number. It's exactly what we want to see. GDP, gross domestic product, that's the total of all goods and services in the United States that are provided, public and private. And realistically, this should go up every year just by the nature of population growth. Every year, more kids are born, babies are born, than people that we lose. So we normally will see about 0.5 to 1.5% just from that. And 2 to 3 is our norm. We don't want, if it gets much higher than that, then we risk inflation. And if we get much lower than that, we risk stagflation. Inflation, also, we want to be in the 2 to 4% range, exactly where we were. So the Fed raising rates, bringing things back into check, got it exactly where we want it. Unemployment below 5%, it's been in the 4% range. So here you see GDP again was 2 to 3, inflation 2, and unemployment in 4%. So what makes up the GDP? The main component of the GDP growth came from consumption or just regular personal spending. I really like that. I think that number is about 63%, give or take, of all the things that caused the growth last year. And what's great about that is it means that we were spending money. It means that we felt good about the economy. It means unemployment was good, inflation, all that like I talked about, and we felt good about going out and buying goods and services and going out to eat and going on vacations. So that's a great indicator of a stable economy. Inflation, like I talked about, very much in check. We see that spike that got out of control. It got in the 8% range a couple of years ago, 2021, 22. came back down below 4, around 4 and below, which is exactly where we want it. Now, I get a lot of questions about, yeah, but how are they measuring inflation, right? They move the target, they change things. It doesn't matter. On an apples-to-apples basis, inflation is below historic average in a very comfortable range, exactly where we want it. Now, when I say that, you may be thinking, but yeah, Darren, why is it that my cost of going to the grocery store is still so high if inflation came back in check? Well, the reason is there's this funny thing called compound growth. You may have heard of this, like one of the eighth wonder of the world or ninth wonder. Because we had inflation at 8% a couple of years ago, when you have 3% to trail that, it's going up 3% on 8%. So that's why we're still feeling some pain, but it's getting back in check where we want it. Fed funds rate, last couple of times they've lowered the rate last year. They expect to lower it some more, and that has helped keep inflation in check. You'll notice that the blue and red lines, which are inflation and the Fed funds rate, are very correlated, right? So when inflation starts to get high, they'll adjust that Fed funds rate. That's why you hear that so much on the TV when they talk about the committee getting together and adjusting the rate. Right now, it's at about 4.33%. We expect that to come down a little bit more this year. Probably, they said they're going to lower it twice, about a quarter point each time is the expectation. But, of course, we're going to have to see what inflation does as the year goes on because they're going to want to make sure they don't go too far to push it down. Okay. All right. This is a slide. If you all know me, and 90% of the room knows me. In fact, last night, Byron was talking about me being a half glass full guy. Well, this is one of my only negative slides in the presentation. What this shows is the total, it doesn't show the total government debt, but the total debt's about $32 trillion, okay? We know it's out of control, and now we throw around billions and trillions like it's nothing, but we know it's out of control. What this is showing, though, that big bar is 2025, this year, and that is the amount of U.S. government debt that's going to mature this year, which is $6 trillion. Okay, so about 20% of the total U.S. debt is going to mature this year. What does that mean? It means a couple of things. One, the government has no choice but to repay those bondholders. Now, there's a couple of ways they could do that. They can reissue new debt, which from what I'm reading and hearing, it's not likely they'll do that. What they're going to do more than likely is roll over that debt into new, basically new bonds under the same issuance, hopefully to the same bondholders. That'll keep the rates from going up as much as if they refinanced. That said, the rate that the government's going to have to pay is going to go up. There's just no doubt about it. Well, what's that mean? It means two negative things. One, they got to figure out how to come up with $6 trillion. Two, their financing costs is going way up. You know, if you have family members, or we've got a home builder in the room here, we've got realtors, mortgage brokers, you know, it costs more to buy a house now, right? Because interest rates are higher. The reality is interest rates, mortgage rates are still around historic averages or norms, but they're they're double what they were a few years ago. Well, now the government is in a position where they have to finance a double a $6 trillion debt, what they did just a couple of years ago. Now, you heard us, Armin and I presented a few years ago, and we said, why isn't the government issuing 50 and 100-year debt? If we're at all-time lows, if we're at 0 to 2% interest rates, why wouldn't they just issue 50 and 100-year debt? We can't answer that. They didn't take our advice. In fact, they didn't take our calls. But in hindsight, we sure wish they had, because what this means now is they're going to have to pay higher rates. And in fact, when we talked about the government debt a few years ago, of course, it's one of the main questions we get, right? Especially at events. How do we feel about the government debt? How does that affect the markets and our economy? Well, up until a few years ago, even though the debt was totally out of control from an outstanding dollar standpoint, the reality was, with interest rates so low, the cost of servicing the debt was below historic average until recently. And now it's going to skyrocket with the rising rates. Okay? If you think about when you bought a home or a family member buying a home, the reality is you don't really care what the price of the home is and what the interest rate on your mortgage is, right? We should care about that. But what we really care about is what is the monthly payment. We know what we can afford in a monthly payment. And what's happening now is the payments are going way up. Now, I always like to end with a positive. So I'm going to talk some politics today, but I'm not giving political opinions. I always try to dance that line, right? I like to talk about it factually. There's real politics and government going on. So Of course, a lot of what we're hearing right now is they're trying to lower the cost of government, right? You got Musk and his team and Doge. So the only way that really gets offset is to lower costs. Actually, a couple of ways I'll refer to, but that's the main thing we're hearing about right now. So this is the movement of the Fed funds rate and how it's affected inflation. And what you see, you got PCE and core, which the difference, so PCE is just our normal measure of inflation. Core, the other, let's see, core is the red line, and you see them moving very similar now. Core removes food and energy. Because food and energy could be so wild, right? Gas prices could be so wild. You see that period, 2021, 22, where it spikes because of food and energy. So, but what you see is both of them are in check now. The Fed has done its job. It raised rates appropriately, and now it's coming back down. So like I said, right now, 4.3, expected to come down around 4%, maybe a little bit below. Okay, if you've been to any of my presentations, you have heard me almost incessantly talk about the only thing to focus on is corporate earnings. When you turn on a TV and they talk about geopolitical environment, we talk about all the risks going on, inflation, the only thing that drives the stock market is corporate earnings. Now, the other things will affect it for a day or two, right? You're gonna have an impact from global events that affect the market for a day or two, inflation, et cetera. But the only thing that affects the stock market in the long run is corporate earnings. And the fact of the matter is, they've been solid, they've been growing, the revenues have grown, the profitability has grown, and we're gonna take a look specifically at earnings per share as well. So there's your revenue growth. I'm gonna copy a line from Byron last night. As he said, the only thing I want you to take away from this slide is that it goes from the bottom left to the top right, that line does, which is exactly what we want, right? We wanna see revenue going up and to the right, just like we wanna see the stock market going up and to the right. And they're highly correlated. Just like I said, the only thing that drives stock growth is revenue growth. So this chart is perfect. And in fact, if we focus on the end of it, right, we see that we're on a really high point, and we'll talk about where we expect that to go from here. Profitability, same thing, going steadily up. I thought this was a really interesting chart because this isn't something I've looked at much, and I've never talked about it, is profit margin. So on the revenue growth and all those sales and all the spending, how much on a percentage basis are they earning? How much are they profiting? Well, if you look back just 20 years ago, those profit margins were in the 4 to 6% range. Fast forward, and now you see profit margins in the double digits, 10, 12 plus % profit margin. So think about that. If you raise the top line revenues, right? If people are buying more goods and services and the revenues are going up and the profitability on those revenues are going up, you have a double benefit to the bottom line of net income. Does that make sense? Right? So let's try to put that in, okay, let's say you're going to buy an Apple phone. I'm trying to think of something that everybody can relate to. Probably 90% of the room probably has an Apple phone. I have a Samsung, I get picked on a lot. I'm the one who messes up the group text and everything ends up green. But let's say you're going to buy the Apple iPhone, and let's say that their revenues are going up. Instead of one year they sell $10 billion worth, and the next year they say they sell $12 billion worth, right? So their revenues are up. That's great. But it's only great if their margins either stay the same or go up. So let's just say, for example, that on the $10 billion of sales, they make 10%, they made $1 billion. That next year when they sell $12 billion, if the margins continue to go up and now they're up to 12%, they're making more money twice. They've sold more and they made more on each dollar. So that's what we're seeing here on these combination of charts is both revenue growth and margin growth at the same time. This is another one of those. We'd like to show you charts and economic data where there's high correlation, right? The red and blue line you can see are very correlated. They move lockstep. You'll notice that when you see those dips, they move together. And what we see right now is earnings growth. In fact, last year, 2024, I mentioned that sweet spot of corporate earnings going up. Last year was up about 16, 17%, the earnings per share. So that's how much on average the stocks were earning per share basis. And that's what's driven the market up. Okay, so where are we now? I know this slide. I've seen this slide. And in order to look at where we're at now, I do want to point back 1 year to give you a reference point. So this is City National Rockdale. It's one of our favorite providers of research and technology. As we manage money, we pull indicators from multiple sources, 4, 5, 6 different sources. And CNR, Community National Rockdale, is one of our favorites. They give these speedometers. There's 20 speedometers and gives us a really nice global outlook at every area of the market and the economy. Looks at monetary policy, it looks at corporate earnings, geopolitics, interest rates, everything across the board. So a year ago, you'll see, I'm going to start at the bottom right, because the bottom right hasn't moved and isn't going to move for a long time. The bottom right is red, and it's geopolitical risk, right? That won't surprise you, right? As long as we're talking about Russia and Ukraine, China, North Korea, of course, Israel and Hamas, anything like that, we're going to have geopolitical risk. So that's been in the red zone for a while. It probably isn't going to change. Besides that, you see a pretty even mix of yellow and red, right? Of course, I probably don't have to tell you, first of all, there's no green on there. I don't have to tell you green would be good, and you don't see any there. The yellow is, of course, the middle zone, and red is always bad. So this is wonderful, right? Fast forward. Oh boy, I hit the wrong button. Okay, fast forward to this year, January. Geopolitical risk, like I said, hasn't changed, but about half of those yellows have moved into the green zone. So monetary policy has improved, interest rates have improved, inflation, corporate earnings, all of that has gotten drastically better, which is awesome. And one of the things I'm going to want to point out to you, as I look at different slides and indicators, they look at different time frames. So Rockdale is what we call a slow twitch. It looks about 3 to 6 months ahead. It's the slowest to move and it's the longest projected. We want to make sure we mix our signals, that we mix a slow twitch with some faster twitch stuff that hopefully I've got those slides also. We'll see when we get there. But this tells us that it's a really good, consistent outlook that what we've seen last year is expected to continue for the next 3 to 6 months. All right, tailwinds. Tailwinds are the things that should help the market continue to grow, the economy to improve. The hottest topic, artificial intelligence, and we put that on the slide, but I really like to talk about technology and innovation broadly. Along with that, we expect corporate earnings to continue to improve, ease lending standards, the banking environment's better, and of course with the current government in place, we do expect some tax reform, especially on the business side. But let me focus on artificial intelligence because this is a trend that I've been talking about not in the last few months or year, but it's the end of the trend that I started in 2009. If you've been coming for a long time, you heard me all the way back in 2009 say this long 15, 20-year forecast where in 29, we expected companies to lower spending, unfortunately fire people and cut employment, cut inventories, and then they would start having more cash and they would hoard that cash until they could find ways to spend it. They would eventually spend it on research and development, which finally happened about 5 or 6 years ago. Okay? Now we're heading to the very last stage of that long forecast that I put out, which means I got to put my thinking cap on, as my mom used to say. I got to come up with the next forecast because it's at the end of the road. The final stage is I do expect one more bit of volatility in the next 3 to 9 months. Why? Somebody I was talking to earlier talked about uncertainty. I think it was Leo. Talked about uncertainty. The market likes certainty. It likes predictability. It likes to know who the president is. It likes to know what inflation is going to be, et cetera. In fact, the market prefers certain bad news versus uncertain news, period. So I think it's going to be a little bit of a downturn. I don't know if that looks like 5%, 10 or 15, but a little downturn from uncertainty. But after that, there's been so much money put into AI and all sorts of innovation and technology. Over the next 5 years, I expect the market and the economy to look entirely different to where we'll see a huge drastic bull run. And we see this historically. When you see the late 90s kind of bull runs, going all the way back, you go all the way back to the steam engine, industrial revolution, the dot-com era before the bubble burst. All these things are periods where the market really takes off, and they're all driven by innovation, right? Back then, the steam engine was an innovation. And it's not just AI. Yes, AI is hot, and yes, the top 4 corporate spenders on AI spent $7 trillion. But regardless of that, the innovation, we just think everything's going to look different over the next 5 years. Transportation is going to look different. Healthcare is going to look different. Education is going to look different. Everything across the board. In fact, I like to really put out these forecasts. I think that, and I think we see this some. I got some doctors in the room, so you can agree with me if I'm right. If I'm wrong, maybe just stay quiet for a little bit. I think over the next few years, I think they're starting to see this where you walk into a doctor's office and there's like a scanner, and the scanner just kind of looks at your body and tells the doctor, here's what's going on in their body. I think we're seeing more and more of that where the technology takes over. So I think those are tailwinds that are highly likely to help us, especially over the next 3 to 5 years. What are the things that can work against us? Now, I'll be real. There's a couple of things on here that I don't think will work against us. Their potential risks is why they're up here. Inflation could be a risk. Bond yields could be a risk. I don't think those are going to be an issue. The only thing I really want to talk to you about is tariffs, which, by the way, I also don't think is going to be an issue or work against us. I always like to throw in a little story, and this is a fun one for me. Tanya was there to witness it, so she can back me, or she can correct me. It's warranted. All right, so we were in Whistler. We were on a gondola going up the mountain. It's like 25 minutes. Am I right on that part? It was about a 25-minute ride? Okay, she said sure. That means I'm wrong, but she's going to let that one go. 25-minute ride on a gondola, and there's 8 of us, I think, on the gondola, and there's a family from Australia. Okay, I probably already have 2 or 3 of the things wrong, but they're close enough that the story will make sense. And this guy across, he could pretty easily identify I was from the United States. And he goes, hey, are you from the United States? I said, yeah. He goes, I've been looking for one of you. Like, okay. Like, are we hard to find? I mean, there's a lot of us around. And of course, he goes into this little bit of a rant, or it wasn't quite a tirade, it was more of a rant. And he said, I just don't understand, why did you all vote for Trump? And why did you vote for Trump? He assumed I did. My first thought is, okay, stay calm. Like, I talk like this whether I'm super excited or super upset, right? So I'm like, okay, first of all, when he's done, you stay calm and level-headed, because elevating this isn't going to do any good. And then I'm thinking, okay, what am I going to say when he's finally done? And he was really focused on tariffs, and he was talking about the negative impact of that. So when he was done, I said, okay, here's the thing. We've been here before. This is not the first time that Trump is president. And it's not the first time as president that he talked about tariffs and threw out numbers like 50%. And guess what? We survived the first time. It didn't blow up the system. The market, the economy did fine. The US didn't blow up. There wasn't rampant inflation, and there wasn't a major impact around the world. In fact, I said, really what he's doing is not even really expecting to charge these high tariffs. At the end of the day, Trump is a negotiator, right? He has a real estate background, strong real estate background. If he's buying a building and he's ready to pay $50 million for the building, he's not offering $50 million. He's going to offer $30 million and negotiate from there, right? So when he puts out a tariff, when he talks about a tariff on Mexico and Canada and others at 50%, he's not actually expecting to charge that tariff. In fact, he's using that to go to the negotiating table and start negotiating. I wish that I could have seen my Australian friend a week later, because this time I couldn't have been more right. Literally days after, it comes out in the news that Mexico, that they came to the table, they talked, and Mexico is sending 10,000 troops to the border to prevent fentanyl and sex trafficking from crossing over the border, which nobody can argue that the net outcome of throwing out a 50% tariff is positive when you're reducing fentanyl and sex trafficking across the border, right? So I think that's the main thing I would suggest you pay attention to as you see it on the news, and especially hear the hype. I don't think this is going to end up being negative. It will be negative hype. I don't think it'll be a negative outcome, because at the end of the day, it's all going to be negotiated and it's all going to sort out. And like I said, we've been here before. It's not new from what happened the last time he was president. All right, so I mentioned, actually, I don't know that I mentioned that one of the negatives on the dials is that stock prices are high. And how do we measure stock prices? When we say stock prices are high or low, we use what's called a PE ratio, okay? You don't have to become an expert. This is actually very simple, straightforward. I'll explain it to you. P is prices. What is the price of a stock or the price of the stock market? And E is just earnings. How much money are they making? When prices get very high relative to earnings, we get a high PE ratio and stocks are overvalued, and vice versa. What this graph is showing you is simply that middle line, PE ratios on average are about 16, 17%. 17 is 16.9 is the average, okay? What you see on the far right, where we sit right now, is well above that, about 21 plus, which means stocks are overvalued. Now, historically, what the market does is go through these cycles. When PE ratios are high, prices come down to get back into the normal range. When PE ratios are low, prices go up to get back into the normal range. There are a couple of ways that can change the formula, though. I'm going to address one in a few minutes. So on one level, this is a bit of a concern. PE ratios are high, but there is a way to overcome it that we'll discuss. The other piece is the earnings, of course, right? The bottom layer. It's not just price. So it doesn't always have to revert to the mean. All right, what are our forecasts? You saw some of these charts earlier in the look back, and what you'll see is very similar forecasts going forward. So we expect GDP to stay in that 2 to 3% growth range. We expect unemployment to stay about 4 to 5%. Very healthy, very steady, very good for the economy. It means that salaries will grow in a comfortable range, comfortable rate, and it means that spending will continue. It means we expect to stay in the sweet spot. I mentioned earlier that even in the good years, right, even when the market has years that are up 20, 30%, let's see, I'll just pick a random year here. If I look at around the late 90s, about 88, 89, market was up 31%, but sometime during that year, the market was down 11%. So even in a year where the market was up 31%, there was a point when clients were calling us worrying, why are my investments down 11%? In fact, I like this slide, but I really like it today because something really hit me today, which is when the market goes down even somewhat drastically, frankly, we don't get a lot of phone calls. I think that's a combination. I hope it's because you trust us and you know we're watching it, we're doing our job. Well, there's two things that really stand out. One, year to date, we're only 2 months in, but the market is up a little bit, 1 to 2%, not a lot, but a little bit. So we should be happy. Our money's up, right? And from the peak a couple weeks ago to where we are today, it's down about 3%. 3% is not a drop that normally triggers us getting calls and questions. So that tells me there's something else that's concerning our clients and the public, right? And I don't know if it's just, well, Leo forecasted. I'm gonna steal his forecast. It's the uncertainty again. They just don't know. Even though we know who's president now, we know what his policies are, we just don't exactly know how it's going to play out. So I think it's that uncertainty. And I did mention I do expect one more drop before we have that big growth driven by some uncertainty. I've already shared with you that we do expect the Fed funds rate to come down some more. We expect 2 more decreases this year. This is just showing that, like I said, right now it's about 4.3. Expected to come down to the high 3s to 4 would be the landing spot. That would be really comfortable. Okay, this is one of my favorite slides and probably one of the main things I really want you to take home because it aligns with everything I've told you at every presentation I've ever did and today, which is at the end of the day, the only thing that drives stock market prices is, anybody? Thank you. Yeah, half of you get a prize. Corporate earnings. All right, so last year, corporate earnings, which is earnings per share is the measure for S&P 500, was up about 16%. The forecast for this year, which is really strong, and it's why the market did well. Now, the reason earnings were good, I mentioned because inflation, interest rates, all that was in check, earnings were good. We expect the same for this year. The takeaway here is the forecast for this year across the board is another 15 to 16% earnings per share growth with modest inflation, modest interest rates, modest unemployment. So very, very positive across the board. So that's actually it. I will take any questions that you all have because I always think that's more fun to talk about whatever is on your mind. And Ullman, I'm so happy you're ahead of me. You will get the first question.
Why has Warren Buffett got so much cash?
Yeah. So for the whole room, the question was, why does Warren Buffett have so much cash? I'm going to surprise you with my first answer because some of you probably won't like my answer. Warren Buffett is not always right, is my first answer and my main answer. If you look, one of the best investors of all time, one of the best stock funds of all time. I'm certainly not beating him up by any measure, but he's not perfect. He doesn't always get it right. And in fact, we would make the case as we sit here right now, while he did fine last year, he did miss some upside, right? Because he had so much cash and the market's was up 23, 25%. There's 2 other reasons. One, I think he's a little bit off. I don't think he should have that much cash. He's smarter than me, or at least has had more success than me, but I disagree with him holding so much cash. I'd like to think his reason is he's waiting for better opportunities. I don't think what you see in the news is there must be something wrong in the market and you must get out of the way, because if he's going to cash, we should go to cash. I don't think that's what's happening. I think he's actually knows there are going to be good opportunities to come. I don't think he's trying to get out of the market, and he's just waiting for those opportunities or working on opportunities is the main reason, besides that he's just not perfect. But when I stand up here and I tell you that our indicators say that we should still be aggressive right now, if that changes in a month, you do not have the authority to come say I was wrong, because today it's aggressive. Sorry, I said that facetiously. I got a couple of chuckles. I'm glad that you understand where I'm coming from, right? Today, that's right. Today we should stay aggressive. And the reality is we've had clients for the last 5 years come to us saying, hey, the market's at all-time highs. Shouldn't we put some cash on the sideline? No, then we might miss some return. 6 months later, market's high. Shouldn't we put some cash, et cetera, et cetera, et cetera? Well, in the meantime, the market's doubled. So that's where we sit today. We're still the market going up, and it's better to be invested. The reason I brought up a month from now, that may change in a month, right? Our signals, I mentioned we have fast and slow twitch different periods. The one I was going to share with you that wasn't on here is the U.S. Leading indicators. It looks at 10 indicators. And right now, that's very positive, but that looks very short term. So it's very optimistic short term. But if things like that and indicators change in the short run, I could stand here in a month and say something different, and it doesn't mean I wouldn't be wrong today, right? Today is today. Make sense? All right. Who's got the next question? Keith, go ahead. I'll hear you, and then I'll share the question to everybody else. Gotcha. All right. So the question was talking about underweight, overweight, and then tying that to corporate revenues and profitability. So he's asking, when they have high revenues but their profitability is low, does that mean they're underweight? In my book, underweight and overweight is a different category of discussion than revenues and profits. So underweight and overweight is typically when you have either, let's say an average weighting is to have 1 to 4% in a specific position, right? If you have a portfolio, maybe you got 1 to 4% in different positions. Well, when the market is good, maybe you adjust up to 5 to 10%, then you're overweighting that stock or overweighting the market because you see good things to come, or underweight in a bad market. The other part you talked about is really important, and it ties to something I shared earlier. When we're looking at companies, we don't just want to look at their earnings, you want to look at their profitability, right? And that's not necessarily underweight or overweight, but it is their overall performance, right? And the tricky thing is, and this is why y'all come to us and don't try to figure it all out, is different companies are looked at differently when it comes to revenues and profitability. Because if you're a tech startup, you could actually have low earnings and or high earnings and low profitability, or negative profitability. You could have losses and look really attractive on the stock market, right? Whereas if you're Coke and you've been around for a number of years, you can't get away with having decreasing earnings or profitability. So I don't know that I exactly answered your question because I twisted it a little bit. Did that address you, or do you have any follow-up? You're good? All right.
Thank you.
Yeah. That was to pass along. That wasn't for you to keep, is it? All right. The question was, what is the mass firing of federal employees? What is the impact that can be on the economy? And I'm gonna add a second question to that because I get it a lot and it's related. A lot of people are asking what the immigration policy impact is going to have, potentially moving people out of the country, and what impact will that have on the economy? Okay, it's another one where my answer might. It's okay if you disagree with me, by the way. I told you can't come a month later and say I was wrong today, because today is today. But you can disagree with me. That's okay. That's allowed. So what I find is when the things that we're talking about that are in the news, like federal employees losing their jobs, or the fact that they want to eliminate the IRS largely, so and even the tax forms that we use, so we wouldn't need a lot of CPAs, for example, and then immigration, et cetera. So we look at that on the surface, we hear it on the news, and we think, logically, that would have to be bad for the economy on the surface level, right? But what we find in practicality and real world is those things actually don't end up being bad for the economy. And why is that? It's because in our country, it is a capitalist country, and it adjusts, right? The jobs move, the job sectors, the job focus, people adjust and learn, and things shift. What's that book? Who Moved My Cheese, right? The cheese moves, but the population and the government and economics move with it. So what do I mean by that? I mean that, I'm going to use a more recent example, right? When COVID hits, everybody goes to work at home. Then eventually some people come back to work, but a lot of people never did. They kept working at home, right? And then some companies more and more started to institute policies, you have to come back to work. But some employees said, nope, I'm not doing it. I don't care. Keep paying me. And that worked for a period of time. And as long as it's working, they'll keep doing it. But eventually somebody may move their cheese and they may have to look for a different job, or they may have to come into the office, whatever it might be. My point is, it's the same thing here, is that while people may lose their jobs or people may have to go back to another country and their cheese is moved, the country and the population will adapt. And we always do. We always have, we always will. And when you look back historically, when topics like this are in the news, they don't end up ultimately being bad for the economy. That's my answer today. This is one where you can tell me later that I'm wrong. That's what I believe today. I believe it with conviction, but I'll leave a door open on this one. In 6 months when we get back together, you could say, yeah, Darren, what do you think now? And that'd be okay. I don't mind that challenge. All right, I have one more sleeve of golf balls. Do you have a question? By the way, sorry. So yesterday, Byron can vouch for this. I got up and he said, who's got questions? And I said, hey, we got some extra prizes. You know, we'll give a hat to the first person that raises their hand who has a question. So what was the first question, Byron?
Can I have the hat?
Can I have the hat? I felt really, really stuck. So fortunately, Byron snagged the hat from me and gave it to the guy. It took the decision out of my hands. Sorry, go ahead.
A couple of questions, actually.
All right. I only have one sleeve of golf balls.
So what are your thoughts on gold, where it is now, in relationship to where the market is?
Yep. You have a follow-up question? I thought you said you had a couple.
Follow-up question is,
Don't set me up. All right, so the first question was, how do we feel about gold, and in particular relative to the overall markets? I've been giving the same answer for about 10 years. Armin gives a similar, but with a twist. I'm not going to give you his twist. I'll just stick with the similar part. So the thing about gold is, I'm actually going to start my own indicator. The more you hear about gold on TV, when you turn on CBC and Fox, etc., the more gold commercials they have, the more you should not buy gold, okay? Because the reality is the largest investors in advertising on CNBC, CNN, I'm not picking on any one station, all of them across the board, is the gold and silver purveyors. Why is that? Okay, first of all, let's talk about what the news channel's purpose is. CNBC, Fox, all of them across the board. What is their purpose? I think I heard make money, sell advertising, right? That was cool. You had a lot of answers, so I didn't catch them all, but I think we all got the general idea. They're in business to make money, sell advertising, and make their shareholders happy, right? So how do they do that? Do they do that by promoting and providing the best news source? Probably not. They do it by creating hype, right? They want to get you very uncomfortable, very uncertain, very scared. They want to play on the uncertainty that Leo talked about that affects the markets, right? And then that creates viewership, and then viewership creates advertising sales, right? So a lot of what you hear about gold is in commercials and on TV, and to go a step further, they're really good at making it not look like advertising or feel like advertising. It feels like it's actually the news that's coming out there. Okay, I just beat that up really bad, but what I really want to say about this is my opinion. It doesn't necessarily represent everybody on our team. In my opinion, gold is something that it's fine for you to own some on your own. If you want to put some in your vault, or you want to own, something like 5% in your portfolio, whatever that looks like, I have no problem with you owning some gold for whatever purpose, whether it's, I don't know that it's a great idea to put some gold bars in your safe in case the world is coming to an end, because I think if you try to leave your house with said gold bar, you're probably not going to make it very far. So I don't think that does the job. But say as an investment, right? As an investment in and of itself, I have no problem holding some gold or silver. I have no problem putting some in the portfolio. It's not something that I think should be overweighted today. Going back to underweight, overweight, I don't think it's something you want to overweight today. I don't think that now's the time And historically, it's not the best performer. And like I said, the more they promote it, the more I'd stay away. It's a great question. I don't mean to. I might have like beat up the answer.
Isn't it inversely related to the market usually?
I don't know about usually. It can be. It can be a safe haven that when some people are trying to avoid the stock market volatility, they can go to gold. But a lot of the old traditional sort of contraindicators, like it used to be the stock and the bond market, worked opposite each other, right? A lot of those have shifted, and you don't see where we like. I'd say for the last 15 years or so, you see where when the market or the economy goes down, the ship all sinks together and it all rises together as well. So, a few years ago, we saw for the first time ever both stocks and bonds drop 10% plus in the same year. And now we see them going up at the same time. So, and then you see the same impact with gold and others. So there's not as many opportunities for non-correlated investments to trade off of each other as it used to be. Good, okay. So the question from Sandy was, what impact can Doge have on the economy at large and the national debt? Okay, regardless of what we believe politically, I would hope, because look, regardless of who the president is, we all don't want debt, right? It doesn't matter who's in office. We may disagree on where they should cut spending and where they should spend, right? But we all want. So the hope would be, now I'll be real here. Sometimes I have details. This isn't a question I can answer in a lot of detail. Like I can't tell you what percentage of the debt they can cut or what percentage of spending they can cut. It's too early, right? They're putting out bits of data, but there's not mass data yet. But the hope would be that they can make a real impact, and the hope would be that we can get our fiscal system back in place where at least we're balanced on an annual basis, the debt can stop growing. Of course, it would be great to start chunking away at it. I also mentioned earlier, even we're going to need some positive impact because we are going to have a negative impact of refinancing federal bonds, treasury bonds at higher rates. So I'm hopeful, I'm optimistic. It's a little too early to know for sure in any more detail. Okay? All right. I got one more, and we'll end with this. If you have other questions, come up to me or to us. I will say before I take your question, Keith, if you are a guest in the room, I'm doing this because I always forget to do it. There's two things in front of you. There's a yellow card, and I think there's chocolates. Right? Is there chocolate? Okay. So thank you for coming. And if you brought a guest, I think you also have chocolates, but not a yellow card. So thank you for bringing a guest. We love guests. And if you'll fill out the card, my team knows my favorite thing to say about the card, I'm not much of a sales guy. I want people who want to talk to us, we want to talk to you. So if you put on the yellow card, we want to talk to you, great. If you don't, the card is very much to tell us that we're not going to follow up with you. You're welcome to check that you want to get our follow-up commentaries, our video updates, whatever else. We do want the information, but if you don't want to meet with us and you don't check that box, I assure you and promise you we will not call you and harass you. But please fill those out. Please enjoy the chocolates. And Keith, what's the last question of the day? Make it a good one. Yeah. So with the pending maturity of $6 trillion of government debt and the refinancing of that or restructuring, whatever it may look like, what is that going to do to yields and spreads? And I think the last part of that is what should we do with our own investments in relation to that? So the natural effect would be that interest rates would go up, okay? And that's what Armin thinks also. I'm going to give both sides because it's supply and demand. If the government is going out to borrow $6 trillion, they should have to pay more for that. I want to know what your smile means so much. It should mean they'd have to pay more. It should mean they have to pay a higher interest rate. That should drive interest rates up, which would drive down the value of your existing bonds, which would mean that there are two things you should potentially do with your bonds. One is hold them to maturity and not do anything. Or if you do want to get out of them, you'd want to sell them before that happens, before the value goes down. Okay, that's the natural answer. I think that's Armin's answer. I don't know Byron's. He's just smiling at me. The other side of that is, I think the Treasury, the government, is going to figure out a way to get through this. I think they're going to figure out a way to keep rates down and push that debt forward. They're not going to be able to reduce the debt. Don't get me wrong. They're not writing it off. It's not going away. And rates will go up from where they are today. But I don't expect actual overall interest rates to change very much. I think they'll find a way to keep rates in line with where they are now. I mean, like I said, they probably have, we know they pushed rates down last year. They expect to do it some more this year. That's probably part of the process, right? Just by bringing the Fed funds rate down and bringing the general interest rates down, I think that's all part of the master plan to keep it in moderation. So it is a negative. I don't want to pretend that I'm ending on a positive note. It is a negative, but I think they'll find a way to make it not as negative as it naturally would be.
There's the positive.
Yeah,
You
yes,
did
I
it
have
on
to.
the- you did
I have
it on
to.
the positive.
The positive is you all had a cannoli. So thank you all so much for coming. Thanks for bearing with me on some of those slides. And look forward to having you next time. I hope you had a great time. Watch for those surveys. We really do care about your feedback. We make adjustments based on it. So please respond on those. And love you all. Appreciate you all. See you next time.